The other thing is sometimes we invest passively, maybe in like a syndication or a partnership. Somebody comes up to us and says, hey, I've got a great project. You're going to earn great returns. Just give me $200,000 of income or give me $200,000. We're going to put it towards our product and we're going to kick back some tax savings.
Welcome to the Peak Profits Podcast, your guide to maximizing returns in passive real estate investing. Hosted by Brian Morris and Chris Ward of 7 Peak Capital, we dive into conversations with industry experts, sharing insights, strategies, and stories to elevate your investment portfolio. Whether you're a seasoned investor or just starting out, this podcast is designed to give you the edge for financial freedom. Get ready to unlock new opportunities, discover the secrets of successful investing, and take your passive real estate investments to the next level. Let's get started and reach those peak profits together.
Hello and welcome back to Peak Profits. Today we are joined by Erik Oliver. Erik holds a Bachelor of Applied Science in Accounting from Westminster College. Prior to joining Cost Segregation Authority, Erik was an operations manager for a multi-million-dollar landscaping and design firm in Long Island, New York. Since heading west and joining Cost Segregation Authority, Erik has been speaking at local, regional, and national events. He brings with him a passion for identifying cost savings and educating commercial real estate owners and investors on the benefits of segregation. Erik, thank you for joining us. We're extremely excited to have you on the podcast today to talk about cost segregation and everything that ultimately involves. But it'd be great if you could give a little introduction of yourself.
Yeah, no, thank you guys. Thanks for having me, Chris and Brian. So as Chris said, my name is Erik Oliver. I'm with a company called CSA Partners. We work exclusively with investors, real estate owners, tax preparers, really on just 3 services that we offer. It's basically cost segregation and then a couple energy credits and deductions. We're kind of a niche accounting firm where we don't do tax returns at our firm. We just partner with tax preparers and investors on doing cost segregation. As you guys know, the tax code is thousands of pages long, and we just learned this little section of this thing called depreciation. And so that's just a little bit about me. My background, as you said, in accounting. I'm actually not a CPA myself. My degree's in accounting. Came across this job about 8 years ago when I was living in New York at the time, looking to come out west. I had some aging parents and wanted to move back home where I grew up here in Salt Lake, and came across this job. And like most people, I had to Google and watch YouTube videos on what cost segregation was before I went to the job interview because I had no clue. So I watched the YouTube videos, found out what it was, and I'm like, well, this kind of makes sense, and I kind of can use my background in accounting. I had some business development background, and so I said, let's take a go for it. So love working with investors over the last 8 years, helping them save tax money, but just want to get the word out there and talk more about cost segregation. So that's why we're here.
Absolutely. And I think that you could provide a ton of value today, and we're excited to talk about it ourselves. And so with that said, could you give us an overview of what cost segregation is? I know we could probably talk hours about this, and a lot of our listeners probably have an understanding that they've heard the word before, but they're not really sure what this piece of the puzzle is in a multifamily investment. So can you help us understand what is cost segregation?
Yeah, so cost segregation really is just accelerated depreciation on your real estate assets. So one of the great benefits of owning real estate or being part of a real estate partnership is the ability to take what they call depreciation. Depreciation is a non-cash expense that comes off of your income, essentially. So depreciation normally happens over either 27 and a half years for residential units or 39 years for commercial units. So let's talk a little bit about what that means, because it's got a little bit different definition in the tax world than it does the real estate world. Residential units in the tax world are anything where somebody lives. So even if it's a 300-unit apartment building, for tax purposes, that's considered residential. And then commercial is anything like a business that's open during the day or open during a certain hours. So your commercial would be your restaurants, office buildings, retail, those types of things. So as again, residential units depreciate over 27 and a half, commercial units over 39 years. So essentially, let's just make the math easy. Let's say I buy an apartment building for $275,000. I take $275,000, divide it by 27 and a half years, and essentially I'm getting a $10,000 write-off every year for the next 27 and a half years. Now, I've oversimplified that a little bit because land is non-depreciable. You always have to back out your land value. But to give you an idea and to make the numbers easy, that $10,000 write-off is basically 1/27th of my total deductions that I get every year for 27 and a half years, which is good. But I, like most investors, probably am not going to hold the property for 27 and a half years. I want my deductions now, and I want them at a faster rate. So the way that I can do that is through an engineering-based study where we go in and identify different parts of the building that the IRS says should depreciate over a faster period. So just as our name entails cost segregation, we're going in and we're taking the cost, the $275,000 in that example, and we're segregating it into different buckets. So for example, I'm here in an office building. There's carpet, there's window coverings. Carpet and window coverings are a 5-year asset. That parking lot behind me is a 15-year asset. So technically, if you don't segregate it, you're actually doing it wrong according to the IRS because we're depreciating our parking lot out back over 39 years, and it should be depreciated over 15 years. This carpet I'm depreciating over 39 years, and it should be depreciated over 5 years. Now, the IRS, the government, they're not going to come tell you, hey, you're not taking a big enough deduction. We owe you more money. They're not going to do that. They want to hold on to it because it's more money for them. So they don't come after people who don't do cost segregation. But technically, according to the tax code, you're doing it wrong because you're depreciating certain assets over an incorrect amount of time. Now, why do we do it that way? The reason we do it that way is because a lot of us work with a tax preparer. We buy a building. We hand the tax preparer our closing statement. And that tax preparer has never been to the building. They don't know that there's window coverings or carpet or parking lots. So what they do is they just treat everything as one lump asset and say, okay, well, this building and all the stuff in it, we're just going to depreciate it over 27 and a half years. They don't know if that's 4-inch concrete or 6-inch concrete outside. So that's where a firm like us comes in, and we identify and we create a revised depreciation schedule that has everything line itemed. We give that to the tax preparer, and that's how the deductions are realized for the client. So that was a long answer to your guys' question, but that's cost segregation in a nutshell, basically.
That's a really, really good overview and extremely helpful and actually very, very simple to understand, Erik, when you put it like that. I will say I've watched those YouTube videos as well, and I think you definitely position it in a much easier way than they ultimately go into. So can you help us understand, like, at what point in time would a cost segregation study be performed? Can that be at any point in time? Is that only when you buy a property? Kind of talk about how a cost segregation study can be applied.
Yeah, no, that's a great question. So cost segregation can be done at any point throughout ownership of the property. So it usually is done once per ownership per building. So if I buy this building today, I do a cost seg study, I sell it in 5 years, it's gone up in value. The new owner can then do cost segregation at the new price because essentially they bought the parking lot, the blinds, the carpet at an increased price than what I bought it at. So there needs to be a new price allocation. So a lot of investors will do it when they first purchase a property just because it gets it out of the way. They can use it for tax planning. There are other investors, and you want to be strategic about when you do it. There's times where you wouldn't do it when you first bought it because maybe you've got some renovations or other expenses, and so you don't need any additional deductions. So you just take your standard deduction, you kind of keep the cost seg study in your back pocket, and then you use that cost segregation study in a year that you have high income. So cost segregation is one of the few deductions that I'm aware of that you can kind of pick and choose when you utilize it. Now, if you don't do it in the first year of the property going into service, there's some additional tax paperwork. It's called a 3115. But that tax form tells the IRS, hey, I've been taking my standard 1/27th of a deduction the last 5 years. I'm now going to accelerate or do a cost segregation study. And it's kind of interesting. On that tax form, you're checking a box that says you went from an impermissible method of depreciation to a permissible. So again, telling the IRS, hey, I screwed up. I was depreciating my carpet over 39 years or 27 and a half years. It should have been over 5 years. And because I made that mistake, you guys owe me this money, basically, is what that form tells you. So again, you want to get with your tax preparer or your tax planner to figure out when is the right time, because there is a right time. You want to use cost segregation to manage your tax brackets. And so if you're in a low tax bracket this year, then maybe cost segregation isn't a good play for this year. But if you're in a high tax bracket, or maybe you've sold a property, you sold another property, you have a large capital gain event, you can utilize cost segregation on a separate property, use those deductions to offset that large capital gain event. So again, you want to be strategic about it, but it is very flexible and it's a great tool for tax planning.
Yeah, that's a great point that you bring up there. I think many times in the multifamily industry, you see that people will offset capital gains from a sale of a property with a new purchase or investment, and then they'll run a cost segregation study on the new property. You got to offset that tax liability on what they're ultimately going to owe that year. And of course, from what you're saying, the IRS never makes it easy, and there's a million different types of paperwork and forms that you have to fill out to try to figure out this yourself. But no, there's definitely seems like there's a huge benefit in doing the cost segregation study. And I know of investors who haven't done it, and then ultimately investors who have, and there's a big reason why. And I guess that brings me to kind of, can you explain depreciation in a way of how investors can take advantage? What is depreciation, right, at a very high level? And what is that? How does that correlate to taxes? And because if I'm going to make an X amount on paper, but I'm showing losses, right? You're making an income, but you're showing losses on paper because of depreciation. What does that mean, and why does that benefit the investor?
Yeah, no, that's a great question, Brian. So depreciation, it acts like an expense. It's a non-cash expense. And basically the IRS gives you a deduction because they say your building is deteriorating over time. So it's not worth as much from year to year. And so, which makes sense because like residential
Right.
units where somebody lives there 24/7 or could live there 24/7, those depreciate faster or they wear down faster than a office building where people are here just 9 to 5. So that's the idea, is that we're giving you a deduction for the wear and tear of your building. Now, that deduction for most people is considered a passive deduction. So this is an important thing for investors to understand. And again, I'm not a CPA, so always consult with that's my warning, right? My obligatory warning to say, hey, I'm not giving you tax advice, so don't come to me when this doesn't work. But the idea is talk to your tax preparer, but typically real estate is considered a passive deduction. So I'll give you a couple live examples. I'm a W-2 employee here at CSA Partners, and I own a long-term rental on the side. Me and my wife have a couple investment properties. If I do a cost segregation study on my long-term rental, I can't use those deductions that increase depreciation to offset my W-2 income. I can use it to offset my rental income. So if my rental properties spit out $100,000 of income every year, and I do a cost seg study, and that cost seg study generates an $80,000 depreciation expense, instead of me being taxed on $100,000 of rental income, my $80,000 depreciation expense knocks this down to $20,000, and I'm only taxed on $20,000. So that's how investors will realize the tax savings is you're taxed on your income, but you've got these deductions, and depreciation is just a type of deduction. So it offsets my income. But remember, in that example, that deduction is a passive deduction, which means it can only be used to offset passive income. So let's say my rental property, that same example, let's say I make $100,000 a year at Cost Seg Authority Partners. I have $1,000 depreciation expense in my long-term rental. I can't use this to offset my W-2 income. So you want to make sure that you got to match up passive income with passive deductions, active income with active deductions. Now, there's a couple ways around that. So one is something called the short-term rental loophole. Maybe some of your listeners have heard about that. But again, I'll give you a real-life example. My wife and I had a tax liability at the end of 2022, and we knew we were going to owe some taxes. So we went out and bought a short-term rental intentionally, not a long-term rental, but a short-term rental. We materially participated in the management of that property. And those deductions from our cost seg study on that short-term rental, they can be used to offset me and my spouse's W-2 income. The reason for that is the government doesn't look at it as a rental property. They look at it as me and my wife are running a hotel business, essentially, because it's an Airbnb. The average stay is less than 7 days. That's one of the criteria. And then we show material participation in the management of that business. And so the IRS says, hey, you're actively managing a hotel business, so those deductions are active, and now I can use those to offset my active W-2 income. My wife is in the school district. We offset some of her school income, and so that worked out. So that's one way to get around that active versus passive. The other thing is sometimes we invest passively, maybe in like a syndication or a partnership. So, somebody comes up to us and says, hey, I've got a great project. You're going to earn great returns. Just give me $200,000 of income, or give me $200,000. We're going to put it towards our product and we're going to kick back some tax savings. Well, with me being a W-2 employee, let's say I invest with somebody else. I give them my $200,000. They do a cost seg study. It creates a $80,000 deduction for me. I'm going to get that on my K1. My K1 is going to show, hey, your contributions to this property earns you a negative $80,000, which everyone's like, wait, I just lost 80 grand? No, you just lost 80 grand on paper. That's actually a good thing. Hopefully the apartment or the multifamily is making money, but on paper, we're showing this loss of 80,000. For me, I can't use that loss to offset my active W-2 income. However, I can use that loss to offset other rental income that maybe I have from other rental properties. That's the first thing. Second thing is, let's say I've got a rental property and it kicks out $10,000 of income a year. I've got this $80,000 deduction. I can now use $10,000 of it to not pay taxes on my $10,000 of rental income. The remaining $70,000 carries forward into future years, and I can use it to offset any kind of passive income in future years. Or what's real slick is, let's say I've got this $70,000 just sitting out here as a carry forward loss. And let's say I sell a building and I have an $80,000 capital gain event. It unlocks this up to the amount of my capital gain. So if I have an $80,000 capital gain event and I have 70,000 of carry forward losses, I can unlock that. And the nice thing is it actually hits my W-2 income, that deduction, versus my capital gain, because my W-2 income is taxed at, let's call it 35%. My capital gain's only taxed at 20%. So I want this 70,000 to hit my W-2 first before it hits I'll go ahead and pay the 20% on the capital gains. I just don't want to pay 35% on my W-2. And so that's one of the great benefits. So sometimes people get worried. They're like, well, listen, I'm a doctor. I've got this extra income. I can give it to you guys to invest in these properties, but I can't really utilize the tax benefit because I don't have any passive income. Well, if you have any other rental properties, or when that multifamily project itself sells and you have a capital gain event, you've got those carry forward, kind of those captured deductions that are just sitting in that bucket waiting to be used. When that capital gains event happens, you use those to offset your capital gains. So there's a lot of ways, a lot of creative ways. Always check with your tax preparer. Some tax preparers are more creative than others, but there are ways to shift income from active to passive, passive to active. But there's usually a way that you can utilize those deductions. And in worst case, if you can't utilize them this year, they just sit in that bucket for when you have that capital gain event, and you can utilize them at that point.
That was a great amount of detail there, Erik. And if anyone listening to this, his brain is a little bit like mine, they're probably thinking about, what passive income have I got versus active income? Where could I potentially offset some of this? Would I have to hold anything over for future years? With the holdover process, I guess I've got two questions. Is there a limit to how long that can be held over, or is that an indefinite amount as long as you're paying or employed and filing taxes? I guess we'll just start with that question.
That's a great question. So it does carry forward indefinitely, so you don't ever lose the deduction. It just carries forward from year to year. There are some limitations on how much you can use the following year. So I believe, and again, I believe it's up to 80% of your income. So let's say I make $100,000 and I've got a $200,000 passive loss sitting in that bucket. I can't offset my full $100,000 of income and wipe out everything. The IRS says you can use up to 80% of your income. So I could wipe out 80,000, which means I'm just paying tax on the 20,000. But I believe it's just that's the limitation that I'm aware of, where you can only use up to 80% of your income to be able to offset. But now, again, everything just carries forward into future years. So if you don't use it all, it just carries forward, but up to 80%.
Perfect. And then I guess my second question around the complexities of all of this is really around what are some of the most commonly overlooked opportunities for leveraging a cost segregation, either the study or as an investor where
Sure.
they can leverage that against their tax liabilities?
That's a great question. The most, well, a couple things. One is the tax law has changed over the course of a number of years. Going back to 2017, there were some major changes to the tax law that really basically put cost segregation on steroids. It made it even more beneficial. So there's something called bonus depreciation, and the government has had bonus depreciation for a number of years. They kind of utilize it to stimulate the economy when the economy needs to be stimulated. So they say, okay, the economy's not doing well, so we want to incentivize people to go out and buy stuff. So that helps manufacturing, it helps people. So they said, how do we incentivize people? So what they do is they introduce bonus depreciation. They say, okay, let's go back to 2017. At the time, it was 50% bonus. So if you bought an asset, it had to be a brand new asset. You couldn't buy a used asset because, again, they want to stimulate the manufacturing area. So they say, okay, go buy a brand new asset, and we're going to give you 50% bonus. So let's just make, again, the math easy. Let's say you buy $1 million bulldozer. Essentially, as long as it's a brand new bulldozer, you would get a $500,000 write-off in the first year, or 50%. So you get a $500,000 depreciation in the first year. The remaining $500,000 or 50% gets spread out over the useful life of that asset. So you can see people buy stuff at the end of the year to get these tax write-offs, and the government would use bonus to stimulate that. So again, if the economy wasn't doing well, they'd say, hey, instead of 50 this year, let's bump it up to 80. That'll get people to go out and buy stuff. Or if the economy is doing well, they'll say, hey, we don't want to give these extra deductions, so let's bump it down to 30. So they use it to stimulate the economy. Well, 2017, Donald Trump's our president. Donald Trump revised the tax code, and Donald Trump owns real estate. And so he said, wait a minute, we're going to really make this very beneficial for real estate investors. So two things changed. One is they went from 50% bonus to 100%. So now let's use that bulldozer example. Now I buy $1 million bulldozer. I will get $1 million deduction in the first year, 100% of it. I get to write off the whole bulldozer as an expense, which is crazy. It's a huge deduction.
It's unreal.
It is unreal. So any asset that was bought between 9/27 of 17, so September 27th of 17 and 12/31 of 2022 is eligible for this 100% bonus. So that's the first big change. We went from 50 to 100. The second thing, which I thought was very slick, is they added 5 words to the tax code that made all the difference in the world for real estate investors. So remember, I said you had to buy a brand new bulldozer in order for it to be eligible for bonus. They added the words new to you, the taxpayer. So now I don't have to buy a new bulldozer. I can go buy a used bulldozer. It's now new to me, the taxpayer. And so I'm eligible for this 100% bonus. So I don't think half the people who voted for it in Congress even realize what the impact of those 5 words was going to be. And a lot of these people, they're not CPAs, they're not real estate investors, so they don't know. I actually talk to CPAs even today that are like, well, you can't take bonus on real estate because real estate's 27.5 or 39-year assets. So one of the rules in order to take bonus is the asset has to have a useful life of 20 years or less to apply bonus. And then I have to explain to them, well, if we do a cost seg study, we have 5-year carpet, we've got 15-year parking lots. Those are under that 20-year cap, so we can apply bonus. But certainly half the folks, 90% of the folks in Congress had no idea what those 5 words impact would be, because now let's talk about it in terms of real estate. If I go buy an existing building that has old cabinets in it, it has an old parking lot, it's all been used, but I buy it, I can do a cost seg study, I can put a value to my old parking lot, my old cabinets, and now I get 100% of the depreciation on those assets in the first year. So before I would have had to build a brand new building, because remember, it had to be brand new. So I'd have to put new cabinets in, new parking lot, and then I'd be eligible for that 50% bonus. But now I just have to go buy a building, do a cost seg study. This is great for our industry because you have to have a cost seg study done, because if you don't, you just have one asset that's 27.5 years. You don't get bonus on it. But when you do a cost seg study, you now have a 5, 7, and 15-year bucket, and those buckets are eligible for bonus depreciation. So bonus depreciation was at 100%, like I said, 9/27 of 17 through 12/31 of 2022. Starting in 23, it starts to phase out. It goes to 80%. 2024 was 60%. Here in 2025, we're at 40%, and it slowly phases out down to zero in 2027. Now, that's the bad news. Good news is that Congress has gotten together. They actually put together a bill at the beginning of last year to extend the 100% bonus. It gets bipartisan support typically. It made it through the House with bipartisan support almost unanimously. Got to the Senate, and there was a few senators that said, well, we're in the middle of a presidential election this year. If we pass this now, it's going to look good for Biden, and we don't want to do that. So they kind of killed the bill, and they didn't pass it. They said, let's wait till after the presidential election, then we'll reintroduce the bill, and then we can pass it then. So I was hoping they would have had it passed early this year so that we could retro date it for our 2024 tax returns. But it hasn't happened yet. I have heard some rumblings that the Trump administration and Congress, they're getting together and putting together some comprehensive tax bills. But my guess is what's going to happen is that they'll put together a bill, they'll extend the 100% bonus, but it won't take effect until the 2025 tax year. So for those of you that bought properties in 2024, you're probably stuck at that 60%, which is still really good because we were doing cost segregation when there was no bonus. It was just, it's better to depreciate stuff over 5 years versus 39 years. But now when you can add this extra kicker on there of this bonus depreciation, it essentially puts what we do on steroids. So that was a long answer to your question again. But bonus depreciation is important to understand because it can be, you could get, in some instances when we were at 100% bonus, you could get 80% of your down payment back in the way of a tax savings. So you were going to pay that money to the government. They were going to go waste it on whatever. But now I could put that down on a revenue generating property and get most of that back in the term of tax savings because of this bonus depreciation. So it's a great way to build wealth. And that's the whole idea behind why the government utilizes that bonus.
Yeah, that's insane. I mean, the nuggets he's given us here is absolute gold. And it's like some of this stuff doesn't even seem real. And again, most people don't even understand it, but bringing in a professional like yourself to explain it. And I got to say, you're explaining it very well because I thought I knew a lot about it, but you're even letting me understand more about this space than I did previously. And so one thing that comes to mind quickly was, how people can buy like a car that's over like 6,000 and you can like write it off on your business. Is that like kind of the same exact example? If you buy the car via your business?
Yeah, so that's a similar example. So if you buy a car over a certain weight, you can't buy like a small car. They want, if you were buying a box truck, or a lot of people buy, I think it's the Ford Raptor, because I think that's like a regular F-150 is under the weight, but a Ford Raptor has like extra shocks on it or something, so it's over the weight. So a lot of business owners will buy a Ford Raptor for their business and write it off. But that's similar. That's usually under something what they call 179, Section 179, but it has the same implications. It's basically allowing you to accelerate the depreciation of that vehicle all in the first year. And so it's right in the same, it's kind of in the same mind frame as cost segregation or accelerated depreciation. It's just a slightly different tax law that allows you to write off certain business expenses at essentially 100% bonus is what it is. And so, yes, that is exactly what that is.
All right. So now I got to go buy my next car on my business instead of personally. But so no, that brings me to my next thought when you were explaining all of that, which is depreciation recapture, which we hear in the space. And a lot of people don't talk about this. So when you're accelerating depreciation, right, and you're pulling it forward in a cost segregation study, and then you sell the building in 5-7 years, you go full cycle on it. How does depreciation recapture work? Because to my understanding, there's some type of depreciation that you have to give back because you didn't hold the building for the whole length of the period that you said you were going to.
Yep, you got it. So that's a great question. That's a question we probably get asked more than anything by both tax preparers and investors is, hey, Eric, I've heard of this depreciation recapture. My understanding is I've got to pay this back when I sell the building. So isn't cost segregation kind of just a timing thing? I'm getting these deductions now, but I got to turn around and pay them back in the future when I sell it. And the answer is no, not necessarily. And I'll kind of walk through a couple examples. But depreciation recapture, when you sell a building, you pay two types of tax. You pay depreciation recapture and you pay a capital gains tax. That depreciation recapture is calculated based on how much depreciation you've taken. So I'm sitting here saying, hey, front load and take it all in the early years, or as much as the government allows us to. but that just means I have a bigger tax bill. And the answer is you do have to pay some of it back, but you're paying it back at a lower rate on a lesser amount and saving the spread. So I think I'm going to back into this example because it makes more sense. But let's say I buy this office that I'm in for $1 million and I buy all the stuff that comes with it for $1 million. 5 years later, I sell it for $2 million. When I go settle up with the IRS, they're saying, well, Erik, everything's doubled in value and you got to pay tax on it. Because I bought this building and all the stuff in it for $1 million. I'm selling this building and all the stuff in it for $2 million. So everything's doubled in value, which makes sense. Well, my land has gone up in value. The building structure itself has gone up in value, but certainly my dirty stained carpet that's 5 years old isn't worth double what I bought it for. Now, remember, I've used that example earlier that carpet's a 5-year asset. So if I've owned my carpet for 5 years, I've taken my depreciation. What's my book value after owning my carpet for 5 years? It's zero. It has no value according to the IRS. So I should be selling my carpet for zero and not paying tax on that. But when you have everything lumped together on your depreciation schedule as building, so I've got $1 million building here, I sell it for $2 million over here, I can't pull out the value of the carpet because I don't know what the value of the carpet is. It's all just lumped together. So by doing a cost segregation study and knowing the value of the carpet, when I've owned those assets for 5 years, I have to pay no recapture on those. They're fully depreciated. So when I say take your deduction at a high rate, pay back a portion of it, a portion piece is dependent upon how long I've owned it, pay back a portion of it at a lower rate at a future date and save the spread. So when I take my deduction this year with my cost seg study or my depreciation, my standard deductions, that comes off of my ordinary income. So let's say I'm in a 35% tax bracket. My tax savings is at 35%. When I pay some of that back, I'm paying it back at a 20% capital gains rate or a 25% recapture rate, and I'm saving the spread. So long story short, I've kind of run the numbers on this. If you have an asset over 500,000, this game of rate arbitrage works even if you only hold the property for 1 year. If it's a single family home, you bought it for 200,000, you do the cost seg this year, and then you're going to turn around and sell it next year, it's probably not going to make sense to do cost segregation in that example because we might save you $3,000 over here. But then if you got to pay, well, we might save you, let's call it $6,000. But if you got to pay 4 of it back when you sell it next year, and so that means you're only netting a $2,000 tax savings, and then we charge you $3,000 for the study, you're actually losing money. But at that 500 thresh mark, that rate arbitrage makes a lot of sense. And so as long as the original purchase price as long as the original depreciable basis, which is your purchase price minus land value, as long as your original depreciable basis is over 500,000, it even makes sense to do a cost seg, even if you're going to sell it in 1 year. So we oftentimes will work with like commercial real estate brokers, and they'll have somebody come to them and say, hey, I bought a building for $1 million 10 years ago. I want you to sell it for me for $2 million. And these savvy commercial real estate brokers will say, well, have you ever done a cost seg? And if they say no, we'll actually hurry and do a cost seg before they sell the building because they miss out on the time value of money and all that part, but what they make up on is that rate arbitrage because we want to be able to know what they're selling their carpet for. So we have to pull the carpet out of those purchase prices. So again, cost segregation allows you to allocate your sales price to the right buckets, but you got to have buckets to do that. If you just have one bucket that says building, you can't do that. Yeah, so we even do it on, sometimes CPAs will be like, why are you doing a cost seg study right before you sell the building? I just got to pay it all back. I'm like, well, you got to pay some of it back, but you don't have to pay back all the depreciation you took on the carpet. And even if you did pay it all back, you're paying it back at a lower rate and saving the spread. So as long as that delta is bigger than what we're charging you for the fee to do the study, then oftentimes it makes sense. So yeah, recapture is a tricky one. That's probably the most complicated thing we'll talk about today. But if you remember anything from the last 5 minutes of me talking about depreciation recapture, just don't sell your dirty stained carpet for more than you bought it for, and then call me and I'll walk you through the numbers and we'll see if we can save you some money.
So what is the process, Erik, for somebody who, whether they're an owner of a commercial or residential building, to work with somebody like Cost Segregation Authority? And can you kind of walk us through the steps of the analysis to implementing the overall cost segregation?
Yeah, so great question. So the first thing is we don't want to ever engage somebody to work with us if we're not going to save them money. That obviously defeats the purpose. So we always run, and most cost segregation companies out there will run a benefit analysis to give you an idea of the expected tax savings versus what the expected fee would be. And then you share that with your tax preparer and say, hey, these guys can generate this much depreciation. What does that really mean for me? Because I don't know, for example, Chris, I don't know your tax situation. I don't know if you have deductions that you're carrying forward from last year. I don't know if you have other expenses you're writing off. So I can't necessarily tell you without diving deep into your tax return if I can save you money. But what I can tell you is I can get you this much depreciation. So then you take that number, you share it with your tax preparer and say, hey, Erik can get me this much depreciation. Do we use it this year because I'm in a high tax bracket, or do I save it and use it in a future year? Once we've come to the conclusion that you can save significant tax dollars, then you'll sign the engagement letter with us. The IRS does require us to do a site visit, so we'll come out. We're going to look at the property. We don't necessarily have to come out in person. Prior to COVID, we did. We sent our engineers. We're headquartered here in Salt Lake, and we used to send our engineers to Maine, to Hawaii, all over the world. Well, all over the country, not necessarily the world. We have gone to a couple international places, but for the most part, the country. Send them all over. When COVID happened, travel restrictions, we couldn't send them. So we had to start doing a lot of stuff virtually. So on all of our smaller projects, oftentimes can do those site visits virtually. It's similar to like a Zoom call where you've got your smartphone, you're walking around the property, show us the flooring in the kitchen, show us the electrical panels. There's certain things we need to see to conduct the study. For larger properties, we will send somebody out because I don't want some property manager having to spend 4 hours walking around showing us the property. That's not fair. So we'll send our folks out. But once that site visit's completed, we take all that information we gather in the site visit, we come back and we start segregating those costs. And that usually takes about 10 to 14 days for us to pull all the numbers together. Our deliverable to you, the client, and your tax preparer is about a 40 to 50 page report. Quite honestly, Chris and Brian, you're going to go through the first 49 pages. You're going to go to the last page because that's where all the numbers are. You're going to input those numbers into your tax software. The first 49 pages are just exhibits. They're the tax law and why we can do what we can do in case we ever get audited. It's just a bunch of that stuff. But that last page is the revised depreciation schedule. That's going to have all the different costs allocated in those correct buckets. Your tax preparer will upload that into their tax software, and that's how the deductions are realized for you guys. So that's kind of the process. The whole process probably takes 30 to 40 days. A big portion of that is scheduling that site visit because we've got to work with tenants, we've got to work with property managers. But once that site visit's completed, we're usually, like I said, 10 to 14 days after that site visit's completed to get the final results back to you.
That's awesome. And that's not too bad of a timeline, especially when you try to look at what that will do for not only your tax liability, but the investment overall, right? And you mentioned earlier the fee was maybe a few thousand. Does that differ between the size of the property, I'd imagine, or the type of cost segregation you're going to do and perform, or the type of asset as well?
It does, yeah. So our pricing is based on size and scope of each project. So we price each project individually. We do everything from single family rental homes. That's kind of like I should say we even do basement apartments, but single family rentals, you're looking at probably somewhere around $3,000 to complete an engineering based study, which is what the kind of study we do. And it could go up from there to $50,000 for a large office complex with multiple buildings, or we've done ski resorts with different lodges. And so it can go up from there, but we usually want to see at least a 7 to 10x return on our investment. So if you're spending $3,000 with us, we want you to save, roughly $30,000 in taxes. Now, depends on your tax bracket and how much income you have, but that's kind of the return we want to see when it comes to cost seg. So I know that's a wide range, but our fees really are calculated the type of asset. You think about a big empty warehouse where there's nothing in there. That's easy for us to do versus a retail office or a retail space where you've got 9 individual tenants and we got to go into the hair salon, we got to go into Verizon, we got to go into Wingstop, and we got to do each of them individually. that takes a lot more work for us. And so type of asset, the square footage of the building, the square footage of the lot, those are the types of things that kind of go into our pricing model. But it's a wide range. But like I said, we want to see a 7 to 10x return at a minimum when you're doing cost seg.
That makes sense. And you get a new phone, get a haircut, get some wings while you're doing it too.
Yeah.
But no, it sounds like since you've moved to Salt Lake and began in this industry, you've learned obviously a ton, and your understanding of not only the business, but you're implementing a lot of this stuff yourself. You mentioned you have some rental properties yourself, and you try to take advantage of it as much as possible. Since you've made that move and you've been in it for years, can you share like a memorable success story or one of your favorite maybe properties or cost segs that you've done yourself where you've really seen the benefit for a client, whether it be a commercial space, retail, or multifamily?
Yeah, so I'll actually use an example of a car wash because car washes are a unique category. So most asset classes, we usually segregate around 30%. So if you buy $1 million retail building or $1 million multifamily, we're going to find about $300,000 worth of stuff that we take from that long life asset category and we move it into the 5, 7, or 15-year bucket. Car washes are a bit unique. And if you think about it, it makes sense because when you buy a car wash, what are you buying? Are you really buying a building? You're not really buying a building. You're buying land improvements, things like curbs, gutters, asphalt, concrete, landscaping. Those are all 15-year assets. And then the other thing you're buying is a bunch of vacuums and hoses or equipment that those are 5-year assets. So we had a client who bought $1 million building, $1 million car wash, and essentially got $1 million deduction. And so they were able to offset $1 million of income, again, because what they bought. Now you have to minus the land value. I keep oversimplifying. You minus the land value. So they didn't spend $1 million. They spent a little more than $1 million. But once you minus the land value, they had about $1 million worth of land improvements, curbs, gutters, asphalt, vacuums, hoses, all brushes, all that stuff. And because it was during the period where we had 100% bonus, if we move those from a 39-year asset, so normally you give your closing statement to your tax preparer, they see a car wash, they say, well, this is a commercial property. Commercial properties get depreciated over 39 years. So they would so you would get 1/39th of that $1 million every year for the next 39 years. But by us doing a cost seg study, we said, hey, you didn't really buy a building. You bought, again, vacuums and driveways. So we're going to put everything into the 5, 7, and 15-year bucket. It was during that period where you got 100% bonus depreciation on all assets, 15 years or 20 years or less. So they got to take 100% of those deductions in the first year. So again, what do you put down on $1 million car wash? I mean, I don't know, let's say 20%. So you put $200,000 down, but you're getting $1 million deduction. So let's say you're in a 37% tax bracket and you can utilize that $1 million deduction. You saved $370,000. So you actually save money by going and buying a car wash. Save tax dollars. You put $200,000, you came out of pocket $200,000, but you saved $370,000, so you're netting $170,000. So this was an interesting one because that car wash that they bought, it actually wasn't a high producing car wash. It was breaking even, but what they did is they bought it, did the cost seg study, got this huge deduction. The following year, they knocked the car wash down, scraped it down to the ground, and built fourplexes on there. And then they got to take depreciation on their fourplexes. And when you do that, you don't even have to pay any recapture on that depreciation you've taken because you've scrapped the whole building. So it was a win-win-win-win in a number of different areas. So that's probably the most unique where we were able to save somebody the highest amount, not necessarily the highest amount, but the highest percentage based on what they bought. We've done some really large projects where people have saved, millions of dollars in tax savings. In that example, they actually came out ahead for them and their investors at the time because they were able to do it on the car wash. So the other unique examples are mobile home parks. Again, when you buy a mobile home park, you're just buying dirt and cement pads and trailer services. And then gas stations have a unique category as well where you can get a pretty high percentage. But so kind of a unique example.
All I can say to that is bring back 100% bonus depreciation.
Yes. I think it's going to come back. I think it's just a matter of time. They're already talking about it. So hopefully Congress can get their act together and get it passed here soon. So we'll wait and see.
Yeah, that is like those stories alone. Again, I think anyone listening to this is probably going to be scrambling around trying to think and figure out how they can leverage all of that. I'm certainly sat here kind of light bulbs going off all over the place. What can I ultimately do with some of this stuff? For those investors who have maybe not considered this, Erik, and have either bought properties in the past, I think you mentioned earlier that this can be performed at any point in time, right? So this is really just about understanding it, reaching out to somebody like yourself to have those conversations, to have a cost study put in place. Is that correct?
Yeah, you got it. So some of the best results are those properties where you've owned it for 5 or 6 years. You didn't do the cost seg study. You hear about it now, or maybe you've got a tax liability, you owe the IRS some money, so now's the year to do it. So because you've been taking just that 1/27th or 1/39th of a deduction, when we do the cost segregation study this year, we're actually going to go back and act like we did it in the first year you bought it. And all that missed depreciation that you should have been taking over those years, we're going to bring all that forward and drop it on your current tax return. And the nice thing is you don't have to actually go back and amend anything. That form I was talking about, it's called a 3115 or a 3115. But that tax form 3115 allows you to take that deduction this year, all that missed depreciation, bring it forward, take it this year without having to amend. And so, yeah, those are great. Those oftentimes can create large benefits because we're getting all that missed depreciation and bringing it.
That makes me think I bought a 3-unit in 2016 and never did a cost segregation study. So maybe it's something to look into now.
That would be. When did you buy? Do you remember? Did you after September 27th or before? Do you remember?
After October 31st.
Eligible for bonus depreciation. So you're going to get 100% bonus on all those short life assets.
Let's go.
So that might be worth looking at. So again, get with your tax preparer. If you end up having a tax liability for this year, we just go back and pull that property. We do the cost seg and hopefully wipe out most, if not all, of your tax liability for this year.
It is absolutely something I'm going to explore, and I'll have a talk with my accountant, and we'll figure that out. But no, this is amazing, and you've provided so much content and educational information today that even being in the industry, for years now, that I didn't even realize, and you laid it out in a way that was very easy to understand. Where can people go to find you, Erik, if they want to get in touch with you about potentially cost segregations or getting in touch with you about their business? Where can they find you online or on socials?
Yeah, so that's a good question. So best place to find me is at our website. So our website is just www.csap.com. So I will mention we did have a rebrand here in February. So we used to be Cost Segregation Authority. Now we're CSAP, which is Cost Segregation Authority Partners. It's a lot nicer because I have a lot smaller email address. So now it's just Erik at CSAP versus Erik at costsegauthority.com. So that's why there might be some confusion. If you hear Cost Seg Authority, that's us, but we're now CSAP. So CSAP.com is our website. You can gather my contact information there. We do have a button there where you can get a free benefit analysis. So for example, for you, Brian, you'd click on that button. You'd say, hey, here's some information on my property. We would reach out to you. We'd ask you some few additional questions, and then we'll generate a benefit analysis free of charge. You can usually turn those around in 24 to 48 hours. So that's the best place to get a hold of us. I'm also on LinkedIn. It's Erik with a K, just E-R-I-K. Last name is Oliver, O-L-I-V-E-R. And again, I'm at CSAP Partners or Cost Seg Authority as well. So, but yeah, please use this as a resource, you guys. We're kind of a niche accounting firm. We don't bill by the hour. So if you call me and ask me a question, I'm not going to send you an invoice. Please don't call me and ask me about earned business income or child tax credits because I don't know anything about that stuff. So I'm just going to send you back to your tax preparer. But if you've got questions specific to depreciation or cost segregation, I'm happy to help. I always joke, I think the weirdest question I've been asked is how to depreciate deer at a breeding facility in Wisconsin. I'm like, I didn't know the answer to that, but I was able to talk to one of our guys here and get the answers. So please use this as a resource, guys. Again, we're happy to help any way we can.
Really do appreciate that, Erik. And we'll put all of the links in the show notes so anyone can quickly link to that. Brian will probably take you up on the offer of calling you at any point in time. So you'll probably get quite a few phone calls from Brian. But again, as Brian mentioned, this has been really, really beneficial. I'm sure we're going to get lots of people listening and asking a ton of questions around cost segregation. So just want to say a really big thank you again for breaking this down to a very, very easy to understand level, not only for our listeners, but for Brian and myself as well. As he said, like we did understand what it was, but I would say not to this level of detail. So thank you again, Erik. Really do appreciate your time.
Yep, no problem. Thank you, Chris, for having me.
Thank you for tuning in to the Peak Profits Podcast. We hope today's episode was not only inspiring, but packed with actionable insights for your passive real estate investments. Subscribe so you never miss an episode. And if you enjoyed the show, please leave us a review. Your feedback fuels our passion to bring you even more valuable content. Stay connected with us on social media and visit 7peakcapital.com for exclusive resources and updates. Until next time, keep striving towards your financial goals and let's reach new peaks together.